The secrets of Elliott wave validation revealed. The secrets of Elliott waves validation revealed. Good morning, good afternoon, good evening, bonjour, bonsoir, mes amis. Guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW 24 traders. For Elliott Wave Trading, our website is www.24elliottwaves.com. The title of the video is The Secrets of Elliott Wave Validation Revealed. Happy Easter to you all, and I would like to take this opportunity to thank our subscribers, for following us, for supporting us, for asking relevant questions in the comment section. Today, as I promise you, that I will not hold any secret when it comes to the Elliott wave analysis. Today, I have decided to share with you one of my secret of Elliott wave validation, because you deserve it. And in fact, the Elliott wave theory is a free theory. Therefore, I will share it with you for free. Okay. So we have here. So pay attention carefully, because what we are discussing here is very, very important. We have here price line group incorporation. The epic is PCLN, Papa Charlie Lima November. This is an American stock listed on the Nasdaq 100. And I'm on a monthly chart, okay? I have already drawn lines on my chart. My wave count is here. And I want you to follow me as I'm counting the wave on the monthly chart. Following our guidelines, we can see clearly here on this monthly chart that price line group incorporation was consolidating between the year of 2004 to 2007 almost, 2004 to 2007. The price confined between the price level of $7 and $30. So we have a range of $23 between 2004 and 2007, okay? Following our guideline, we see a breakout, which is the first Elliott wave. The first Elliott wave very often will break above, the consolidation session. This is the signature of the bull in an uptrend, and the first bearish wave will break below the consolidation. That will be the signature of the bearish traders, okay? So this is the first Elliott wave, all right? And then we have the second wave. Following our guidelines, the second wave should not cancel the first wave. If the second wave cancels the first wave, we will restart counting the wave. Here it almost canceled, because it went to the 78.6% Fibonacci retracement level of this first wave here. So we will put a bit of question mark on this bullish progression and go to Google Finance, Yahoo Finance, to check the fundamental at this point in time, okay? So then we have the third Elliott wave, from here all the way up here. But you have to understand that the wave count is dynamic, because as it goes up like this and pull back, we will be calling this session here as the third Elliott wave, all right? But as the price is moving up, we have now discovered that, in fact, the real third Elliott wave has been extended and has been subdivided into 5 mono waves. All right, but when we were here, we will say this is the third wave, this is the fourth wave, and the fifth wave right here. But then look what has happened. Right, pull back, went up, pull back, went up again. So now we understand that, in fact, the third Elliott wave has been extended from 2009, the beginning of the bullish stock market. You remember, from 2007 to 2008, we have the bearish correction, all right? From 2009, the general stock market, the S&P 500, the Dow Jones, the FTSE 100, the CAC 40, the DAX 30, all, began, a bullish trend. So that session from 2009 to 2012, in fact, up to mid-2012, we have the third Elliott wave that has been subdivided into 5 mono waves. First mono wave, second mono wave, third mono wave, fourth mono wave, and the fifth mono wave. Remember that the title of the video is The Secret of Elliott waves, okay, validation reveal, okay. So when we are counting the Elliott wave, the next step is to validate the wave count. This is a challenge for a lot of Elliott wave students. They know how to count waves, but they do not know how to validate their wave count. And today, I want to share with you, okay, the secret of, okay, Elliott wave count validation, okay. So we have our third Elliott wave that has ended here. Now we have the fourth Elliott wave. As always, very often, if the third Elliott wave is prolonged, the fourth wave is usually very shallow, something like 38.2% Fibonacci retracement level of the third wave. So we have the fourth Elliott wave here, which I usually color into pink, okay, followed by the fifth Elliott wave that has been a bit prolonged here, all right. If you look at the magnitude of the fifth wave and the third wave is almost equal, okay. Here it is, it went up a bit far. This is quite a bullish financial instrument. So now I have counted my wave on a monthly chart. So we're going to talk about how do we validate, okay, our wave count. What I will do, I will link this video to another video that I have already recorded at 24 Elliott Waves YouTube channel, which I call how I validate my wave counts. This will allow me not to, okay, talk too much today, all right? All right, that will allow me to reduce the length of this video. So I will refer further to that video. I'll put the link in the description section. If you check the description section, there's no link. You can remind me because at one point I will put it back there, okay? So I will link it at one point, okay? How I validate my wave count like a pro. Check it out at 24 Elliott Wave YouTube channel, okay? So I already explained to trader how I validate my wave count, but today I want to give you the key to the wave validation, all right? So if you are counting your wave on a 50-minute time frame, which time frame should you go to validate your wave count? This is about the secret of the Elliott wave count. If you are counting your wave on an hourly time frame, which time frame should you go for the validation of your wave count, all right? What is the primary time frame that you should use to validate your wave count on a 50-minute time frame, on an hourly time frame, on a daily chart, on a monthly chart, okay, and so on, all right? There is a specific, okay, secret that I will share with you today, all right? So now I have my wave count, so my multi-wave is from the beginning of the first wave to the end of the fifth wave. Now we have what we call a double retracement, bringing to our mind which chart pattern, the flat correction. So this is a double retracement here because we know the pattern for the double retracement, 1, 2, 3, 1, 2, 3, all right? And then we will expect what? Talking about the flat correction, 1, 2, 3, 4, 5. Wake up, my friend, all right? How long have you been following us? So you know it now, okay? If you don't know about a flat correction, go to www.24elliottwaves.com or check our videos at YouTube channel, 24 Elliott Wave YouTube channel. So we have here a double retracement, 1, 2, 3, 1, 2, 3. Now we will expect what? 1. We are expecting what? 1, 2, 3, 4, 5. All right? Forming the flat correction. Remember that we have a different type of flat correction, the expanded flat correction, the running flat correction, and the classic flat correction. You want to know where and when a pattern is formed, and this flat correction very often will be formed at the end of a bullish trend or a downtrend, okay? So we have a multi-wave that has ended. Now we are seeing a double retracement here. What do you need to do at this point in time? You go to Google Finance, you perform Google Asset test for Priceline Group Incorporation. You check Apple stock. Is this forming, okay, some bearish chart pattern, all right? And you will also check the S&P 500. Where are we? What's going on? This may be prolonged because we're in 2016. As I told trader before, we need to be careful, be patient. Somewhere around July, we may see, okay, some profit taking or harvest time, okay? It's nothing to do with, okay, bearish, okay, but harvest time, okay? So we have count 5 waves, okay? How do we go about to validate our wave count, okay? There is a ratio, all right, that we use. If you are counting your wave, okay, on a 15-minute chart, which we use very often because we see a lot of flat correction on a 15-minute chart. Did I say that? Yes, we do. All right, 15-minute chart. If you're counting your wave on a 15-minute chart, you will validate your wave count on which time frame? On the 4-hour chart. Great, you know it now? On the 4-hour chart, okay? If you are counting your wave on the hourly chart, you will use, okay, the daily chart to validate your wave count on the hourly chart. All right? If you are counting your wave, okay, on the daily chart, you will use the monthly chart to validate your wave count. Okay? These are few secrets that I'm sharing with you today. If you are counting your wave on the monthly chart, as I'm doing here, you will validate your wave count on the yearly chart because we do not have enough data to go to a different time frame higher than the yearly chart. So the only option that I have is to tell you that if you are counting your wave on the monthly chart, we should go to the yearly chart to validate our wave count. So what is about the wave validation? To summarize the wave validation to you, my friend, it's all based on the market stable data. What is intact in this messy market? Well, there are a few things, okay? We know that if the price is trending, whatever the price is doing, the price is always heading to a specific level. So it's going up, it goes from one key level and it's heading to another key level that we call price target. So if we are talking about this trend that has begun here to this point here, it's from one key level to another key level. So when you, because I'm counting my wave on a monthly chart, if I go to the yearly chart, I will use tools like this, Fibonacci extension levels on the yearly chart, because sometimes those key levels, talking about Fibonacci extension level, are hidden support and resistance level. You use Fibonacci extension on your validation time frame. You use the key support and resistance level, which level? The high, the low, the median line, the opening, and the closing price on the yearly charts. Those are key levels. So let me say this again. The price always going from one key level to the next key level, whether it's going up or down or consolidating, all right? So to find those key levels, we go to the yearly chart, we draw the high, the low, and the median line, the opening price, and the closing price of any candlestick on the yearly chart. Any candlestick on the yearly chart, any. Those key levels, that's what the price is navigating from one key level to the next key level. Okay, maybe there's something you do not get now. Let's go to the yearly chart, okay? I'm going to start drawing line on my yearly chart, but there are something blocking my view here because of my drawing on the monthly chart. I'm just going to just show you quickly what I meant by price going from one key level to another key level. So I'm just drawing some line here, you see, at the low of this candle, okay? And I'm going to switch to the monthly chart and see the reaction of the price around. This is the closing price here for this one here. And then I'm just going to switch back. So I'm going to put another line here, which is the high of this candle here. All right. And then I'm going to put another line here at the closing price of this candle here. And then pay attention. All these lines, I draw them. These are key level. Those are key level on the yearly chart. And then I'm going to go quickly to the monthly chart because I don't want the video to be too long, my friend. Traders are very busy people. So here it is, my friend. The price is always going from one key level. So from here, this key level where you went to the next key level. Did you see now? Now it start going down from here. What is it going? Going to another key level. You came here, stop. Now it come down. Here, this key level. Now it start going up. You went to the key level here. Now you pull back to this key level here. Now you head up, key level, all key level. Always going from one key level to another key level, or sometimes from one trend line to another trend line. So let me remove the horizontal line. I want you to get this so you don't get confused. The price is always going from one key level to the next key level. Sometimes you may not see straight away those key levels on the yearly chart. Therefore, what do we use? We use a Fibonacci extensions level. The Fibonacci extension level will reveal to us hidden support and resistance level that we cannot see on the chart itself. All right? So based on the market stable data, the price is always going from one key level to another key level. So though we have seen here the price went up in 5 waves, first wave, second wave, third wave, fourth wave, fifth wave, it went up from one key level to another key level. Though on the yearly chart, when we were here, you cannot see those key levels. We will use Fibonacci extension and also channel projection. Go to Wave Genius at 24 area Wave Genius part 1, Wave Genius part 2, the projection of channel, the range to determine where the price is likely to go. The projection of the channel will also reveal to us key levels, okay? So, when we are counting wave on the 50-minute chart and we go to the 4-hour chart, we want to know where are the key levels. The key level that we can see on the 4-hour chart and a hidden key level using the Fibonacci extension level on the 4-hour chart. You will see very often that the multi-wave will go from one key level to another key level. So you have a bit of idea where the price is likely to go and end. All right? And the projection of the channel. So Fibonacci extension, projection of a channel, okay? All right? Normal key level will help us, okay, to validate our wave count, all right? As I was also telling you before, we also pay attention to what, all right? The trend line. So here it is, the high of the first wave. We are connecting it to the high of the third wave to determine where the fifth wave is likely to end. Here it is, but it breaks through it. As it breaks through it, okay, next level. So you see this trend line here that I draw now. I'm going to color it now into orange. Okay, pay attention to that orange line on my chart. It's a trend line connecting the high of the first wave and the high of the third wave. Look what's happened recently. This double retracement that began 1, 2, 3, 1, 2, 3. So price pullback 1, 2 on the edge of the orange line, joining, okay, the high of the first wave and the high of the third area wave on the edge of that trend line. So the key levels and the key trend lines. So with this information, we are likely to navigate through the market. So you see here, 1, 2, 3, 1, 2, 3, boom, down, it breaks through that trend line, coming to the edge of that trend line. So 1, 2, 3, 4, 5. That's our expectation. That remains to be seen. Remember that a correction can be a complex correction. So if you see it goes up again, and then from 1, 2, 3 again, don't be surprised. There are complex corrections. All right? So for the secret of area wave count validation, you count the wave on a 50-minute chart. You will validate the wave on which time frame? On the 4-hour chart. Okay? You count the wave on a daily chart. You will validate the wave on a monthly chart. Okay? You count the wave, okay, on the daily chart. You validate on the monthly chart. You count the wave on the monthly chart. Okay? You validate the wave on the yearly chart. Normally, we should go to a higher time frame than the yearly chart to validate the monthly wave count. But because we only have the yearly chart, therefore we are using the yearly chart. There is a specific ratio that we must apply. Well, that's the secret I will tell you now. There is a ratio that we must use to validate our wave count. The ratio, ladies and gentlemen, it took me some time because I spent a lot of my time looking at the chart, trying to understand. That's the bottom line. Anytime I see something, I want to simplify it. I want to understand it. So I went a little bit too far, all right, without blinking, so to speak, all right? And I finally discovered that there is a specific ratio that the area wave validation, okay, is respecting. The ratio is 1 to 22. 1 divided by 22. That's the secret today, my friend. 1 divided by 22. You will notice that if you multiply 15 by 22, may not be exactly equal to 240 minutes, but because the exact ratio, talking about the fractal pattern, the relationship between the waves on one particular time frame compared to the higher time frame is 1 divided by 22. This is to give you a happy Easter gift today. So normally, if we are counting the wave on the 1 minute time frame, the correct time frame to validate our wave count is 22 minutes. All right. If you are counting the wave on the hourly chart, the exact time frame to validate our wave count is what? 22 hours time frame. But we have which time frame? 24 hours time frame. But I know that there are some charting software that will allow you to have exactly 22 hours time frame. Sierra charts. Sierra charts. All right? SIERRA. Okay? Sierra India Echo Romeo Alpha. Sierra chart. Now that charting software allow traders to do many things that they want to do. They do not pay me any money to talk about that because I've used it in the past. Okay? Is one of the charting software that will allow you to have the time frame that you want. But the exact ratio is 1 divided by 22. So when we are talking about daily chart and a monthly chart, so we are considering the monthly chart roughly the nearest time frame to the 22 days. Okay? So we can use the monthly chart because that's what we got to validate our wave counts when we are counting wave on a daily chart. Okay? Now you will notice because we are on the monthly chart, the correct time frame, the exact time frame for a wave validation is 22 months. So 22 months is more than a year, but we don't have a higher time frame than a yearly chart. Therefore, we can use the yearly chart. All right. If you're on a 10-minute time frame, the exact time frame to validate your wave count is 220 minutes. The ratio is 1 to 22. It makes sense? We will use, the key resistance level, the Fibonacci retracement level, the key trend line on the higher time frame, the corresponding higher time frame to validate our wave count because the price will go from one key level to the next key levels. So if we have one key level here, another key level here, the price will form 5-way, 1, 2, 3, 4, 5, from a support level to a resistance level. Then the multi-wave has ended, and then a bit of correction. If the cycle will be prolonged after the correction, a new cycle will start again, and then we will use the range of the prior cycle to determine, the size of, to predict or to forecast the next cycle, as I showed traders recently at 24elliottwave.com, 24elliottwave YouTube channel. It makes sense? It is also powerful. So you count your wave on a 50-minute time frame, all right? You can go to the 4-hour time frame. But I want you to understand for today that there is an exact ratio is 1 to 22 when we are using different time frames. So if you're on a 5-minute time frame, you will do 5 minutes times 22, all right? All right? 10, okay? 110 minutes, okay? So multiply by 22 will be the exact time for validating your wave counts, all right? But if you do not have that time frame, so we can use 5 minutes, okay? And the nearest time frame to that will be the 2-hour time frame. So we can use the 5 minutes and the 2-hour time frame. We can use 50 minutes and the 4-hour. That's the nearest time frame. Remember, the wave count or the wave validation is not an exact science. There are some observations that we have made, is that there is an exact ratio between, the wave count time frame or the internal waves, and the bigger time frame and the higher time frame, all right? So the internal waves that we see on the lower time frame, you will see that this third wave that has been subdivided into 5 waves, you will notice if you check, carefully, it will be from one key level, to another key level. Either a normal key support and resistance level, or a Fibonacci extension level, or a projection of a channel. The same thing if you check carefully, the movement from the 5th wave, to the end of the 5th wave is also from one key level to another key level, using those key support and resistance level. On a corresponding time frame, we can validate our wave count and know exactly what is happening. Do not forget, the trend line. Look, the high of the first wave and the high of the third wave allow us to know exactly that we have 1, 2, 3, 1, 2, 3, and then 1, 2. We are expecting now 3 move down in normal condition, unless we have what? A complex correction. All right, it makes sense. The market may be consolidating until the right time before the bearish profit taking may take place. All right. If you have any question, put in the comment section. All right. If you have any suggestion, put in the comment section. And in due course, I'll record another video to answer your specific question. The takeaway in this video is that there is a specific ratio between the time frames. We are counting wave on X time frame. The corresponding time frame to validate the wave count is 22X time frame. That's the general formula for the validation of the wave count. But the Elliott wave count is not an exact science. We can use the 50-minute chart and the 4-hour chart, the hourly chart and the daily charts, all right? The daily chart and the monthly chart and the yearly chart. All right, it makes sense? It is also powerful. We can also use the weekly chart and the quarterly charts, okay? So you can count wave on the weekly chart and then you can validate that on the quarterly charts. Until the next time, enjoy yourself and be very happy. We are the TSTW24 traders talking about the secrets of Elliott wave count validation revealed. Happy trading to you all and speak to you soon.